Would you drive a car that doesn't have brake? Your answer is no. Why? Because it's risky? Perfect. So you know that you should protect yourself from risk. And when it comes to trading, there is no difference. There is risk, and you need to protect yourself from the risk. You can never totally remove it, but you need to manage your risk properly. Otherwise, your trading account. Risk management is one of the most important aspects of trading. It is the key to become a consistently profitable trader. Without a proper risk management strategy, you will definitely lose your trading account sooner or later. In this video, I'm going to completely explain risk management strategies, and different tools that you can use for this purpose. I can't emphasize this enough. This is a very, very important subject in trading. So make sure you watch this video until the end and you don't miss any points. Without wasting any more time, let's get started. First of all, you need to completely understand this. Trading is a game of probabilities, not certainties. What does this mean? It means every single trade that you enter, the result is uncertain. You can win or you can lose. Even if you have 99% probability of winning, still the 1% probability of losing is there. You can never have a 100% winning strategy. This is not possible. So if you don't manage your losing trades will be out of control, and 1 or 2 losing trades are enough to wipe all your profit or completely destroy your trading account. So until now, you understand that there is a potential risk in every single trade that you enter, which you can lose not only that trade but even all your trading account if your losing positions are not managed properly. In the second step, you must determine your free capital, the amount you can afford to lose, or the amount that you are allowed to lose if you have a funded trading account. For example, if you are an individual retail trader, the money you are depositing into your trading account, it should not be borrowed money, and it shouldn't hurt your life if you lose that money. So if you want to start trading with the money that you can't afford to lose that money, you should not start trading. Alright, let's see how we can manage the trading risk in practice. If you want to become a successful trader in financial markets, before entering in every single trade, you need to come up with 3 pieces of information. First, you must exactly know at what price you want to enter the trade. So your entry price must be exactly known. Second, you must exactly know at what price you will close your position with profit. In other words, if your analysis is right and the market is going the way that you expected, how much profit you want to take. In other words, how much is your expected profit, and you will close your position and take your profit. And third, you must exactly know at what price you will close your position with loss. In other words, if your analysis is wrong and the market is going against your position, how much loss you are ready to accept. Before you enter the trade, you must exactly know your expected loss and the price that you will close your position with loss. This is how professional traders do. Before every single trade, they exactly know at what price they want to enter, at what price they will take their profit, and at what price they will close their position with loss if the market goes against their position. Successful traders plan the trade and then trade the plan. By planning the trade before entering the position, they don't allow their emotions to play any role in their open positions. So when you come up with your profit target and your loss target, you should set stop loss order and take profit order when you're opening the trade or immediately after you open your position. By using stop loss order, you can prevent big losses, but if there is no stop loss, your loss can just get bigger and bigger when the market is going against you until you lose your whole trading account. Now you may wonder what level of stop loss is optimal to have the lowest impact on your trading account in case if the market goes against you and hit your stop loss, or on the other hand, what level of profit target is considered appropriate in relation to your stop loss to make you a profitable trader in the long run. Before we continue this subject about the appropriate levels of stop loss and profit target and the relationship between them, which is known as risk to reward ratio, first we focus on the risk part and how we can manage it optimally to have minimum effect on our trading account, and then we will talk about the reward part and the risk to reward ratio. Alright, we are on the risk part now, the situation where our position could end up in loss. There are different types of risk management strategies, and one of the best and most effective one, which is very popular among successful traders, is called 1% rule risk management strategy. By the help of this strategy, you can keep your losses minimized by risking only 1% of your trading account. But this 1% risk is not about 1% distance for your stop loss or 1% of your account for position. By the help of this strategy, based on your decided level for stop loss, your position size is calculated in a way that in case if the price hits your stop loss, you will lose only 1% of your trading account. For example, if you have a $1,000 trading account, if your stop loss is hit, you will lose only $10, 1% of your trading account. By using the 1% rule, you can protect your account from falling significantly. Let me make it clear for you. If you lose, for example, half of your trading account in a single trade, you need 100% gain to back to the point that you were. And if you think 100% gain is easy, no, you are wrong. But if you use 1% rule risk management strategy and you lose 10 trades in a row, you approximately lose 10% of your trading account and you approximately need 11% gain to get back to the point that you were. Please pay attention that I said 10 losing trades in a row, which in practice you rarely encounter this unless there is something wrong with your trading strategy and system, which means you need to improve it or change your trading strategy. In a normal situation, you can lose 10% of your trading account, but not usually by 10 losing trades in a row, but it may take months. That again, there should be something wrong with your trading system, which you need to stop trading, reconsider your trading strategy, and improving by increasing your win rate. So you can see that when you use 1% rule risk management strategy, you can protect your trading account, but if you don't use 1% rule, you can easily destroy your trading account to zero, and this is the number one reason why most of beginners lose their trading account. Alright, now let me show you how the position size is calculated based on 1% rule risk management strategy. Consider, for example, we want to buy shares of Apple company and consider the current price of each share is $100, and by the help of the analysis that you have done, you have a buy signal and you want to buy or enter a long position. And based on your analysis, you want to set your stop loss at $98, for example. Consider you have a $10,000 trading account. In other words, you have $10,000 available in your trading account. First, we calculate the amount that we are allowed to lose, which is 1% of our trading account. Our account balance is $10,000 and 1% of $10,000 is equal to $100. So $100 is the maximum amount that we are allowed to lose. In other words, if the price goes against our position and hits our stop loss, we will lose only $100, only 1% of our trading account. Second, we must calculate how much we lose for every share if the price hits the stop loss. The share price is $100 and the stop loss is at $98. So for every share, the loss is $2. And now in the third step, we should calculate how many shares we should buy. We divide the maximum loss amount to the maximum loss per share, 100 for maximum loss amount and 2 for maximum loss per share. And the result is 50. So we must buy 50 shares of Apple company. Every share is $100 and buying 50 shares will cost $5,000. We're going to open a position with half of our trading account. We're going to open a $5,000 position, but there is no worry for us because if the market goes against us and hit our stop loss, we will lose only $100, only 1% of our trading account. This is how we calculate our position size in a way that we will lose only 1% of our trading account if the price reaches to our stop loss. And this method is similarly applied to any other market. In the stock market, it is the number of shares. In forex market, it is the amount of currencies, and in cryptocurrency market, it is the number of coins or fraction of coins if the price is very high like Bitcoin. But this is not all. This is only the risk part, and as I mentioned earlier, the profit part must also be managed properly and there should be a logical relationship between them so you can be a profitable trader in the long run. There is another concept here that you must know about before we continue, and that is win rate. Win rate is the winning percentage of your trading strategy. For example, if you examine your trading strategy 100 times, you calculate how many times you are winner and then you divide the number of winners to the total number of experiments. For example, out of 100 trades, if 60 of them are winner, your win rate is 60%. But wait, how do you know when the trade is considered winner? winner? What level of target is appropriate? And now this is where we should talk about the relationship between your stop loss, profit target, and win rate. When you are risking 1% of your trading account, you should also have a proper profit target based on your stop loss level and win rate. Otherwise, your account cannot be profitable in the long run. The relationship between a stop loss and profit target is called risk to reward ratio. And to become a consistently profitable trader in the long run, you need to have a proper risk to reward ratio based on your winning rate. Risk to reward ratio is usually shown like this, for example 1 to 1.5, and this means you are risking $1 to make $1.5, or another example, risk to reward ratio of 1 to 2 means you are risking $1 to make $2, and this level of profit target depends on the trading strategy. And now the win rate makes sense. For example, you have a trading strategy with average risk to reward ratio of 1.5 and its win rate is 70%, for example. But wait, can you just put your profit target higher and make more profit? No, as I said, it depends on the trading strategy, and if you just increase the level of profit target, it can decrease your win rate. You must have a balance between risk to reward ratio and win rate. Choosing the minimum ratio depends on your win rate. Let me give you an example so you better understand. Consider for a trading strategy with risk to reward ratio of 1.5, you have 50% win rate, which means you are winner only half of the times. Do you think this is a bad win rate? No, let me prove it. Consider we have a $100 trading account and we perform the strategy 100 times. Out of 100 trades, 50 of them are winner and 50 of them are loser. We are performing 1% risk management strategy, so we are risking $1, 1% of our trading account to make $1.5. Our winner trades made $75, our loser trades made $50. So out of 100 trades, we will be in $25 profit. Please pay attention, we didn't calculate the trading fees. This is just an example to show the relationship between risk to reward ratio and win rate. So as you probably understand now, there should be a logical balance between risk, reward, and win rate. The lower your win rate, you need more risk to reward ratio to be profitable in the long run. For example, with winning rate of 30%, you need risk to reward ratio of, for example, 1 to 3, because out of 100 position that you open, you have 30 winners and 70 losers, and this makes $70 loss and $90 profit, and your account will be in $20 profit in the long run. Some trading strategies, especially scalping or day trading strategies, traders just consider a fixed amount for their risk to reward ratio like 1 to 1.5, and by testing and having a proper win rate, for example 60%, they can be sure that they are profitable in the long run no matter if the strategy is doing bad in a single day. But others may not choose a fixed ratio and they may set their profit target based on the condition of the chart, for example closing at a support or resistance level, and for them before the trade they need to calculate the risk to reward ratio for the trade and see if it is offering a proper ratio. For example, for a long position, it is calculated based on this formula: take profit minus entry price divided by entry price minus stop loss, and if the ratio is, for example, below 1, this could not be a good trade if your win rate is not very high, because you are risking more to gain less, and in the long run you will not be profitable if your win rate is not very high. Alright, now you understand how there should be a balance between risk, reward, and win rate. In the first step, the focus is on the risk, to limit the risk as much as possible. I discussed 1% role risk management strategy and how you can limit your loss to a small account like 1% of your trading account, and then by having a proper level of profit target and so a proper risk to reward ratio based on your win rate, you can become a consistently profitable trader in the long run. Alright, now let me introduce some free tools and indicators on TradingView platform that can help you with all the things that I explained until now. On TradingView platform, here we have a projection tool for opening long and short positions. For example, we choose long position and consider, for example, after analyzing the chart, we wanted to enter a long position here. So we click here at this point, and after analyzing the chart, we wanted to place our stop loss here below the previous swing low. So we set our stop loss around here. And then if we go to the settings of the tool, here we can can define our account size. For example, we have a balance of $1,000, and here you can define your risk level, the amount of the risk that you want to take on each trade. And as I said, it is better to stick with 1% rule, and these are the information that we already set. This is our entry price, this is the stop loss level that we already set, and this is the profit level, which is here. This tool based on our account size and the risk level that we have defined here and our stop loss level that we have set at this level, which is here, it calculates the position size exactly based on the method that I explained earlier in this video. And the position size is shown here, which is 4,000, and we can open a position based on this size. And please pay attention that our account balance is $1,000, but we can open a position 4 times higher, which means we can use leverage without any worry, because if the price goes against our position and hit our stop loss, we will lose only $10, 1% of our trading account. Here, based on where we set our profit target, it shows the risk to reward ratio here. So if, for example, based on your trading strategy, you take your profit at a fixed level of 1.5 risk to reward ratio, that would be around here, and this tool helps you to evaluate the risk to reward ratio here. It is shown here, as you can see, and this is the price that you should set for your profit target. And if you choose your profit target based on support or resistance levels in the market, for example, you may want to close your position at this high, you can simply evaluate your risk to reward ratio by setting your profit target at your intended level. And here you can see that, for example, in this case, this is 1.25, so not bad to enter the trade if you have a proper win rate. By the help of this tool, you can easily and quickly calculate the position size and adjust your profit target and evaluate the risk to reward ratio. This is a very handy tool that can effectively help you with risk management and position sizing. Other than this, there are also some indicators, or there are some websites that offer you a calculator, and you can also create your own calculator in Microsoft Excel or Google Sheet very simply. I have a guide on this. The link is also placed in the description, and you can watch it later and make your own calculator. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.